Hey everyone, it's FT Limited, and let's talk about making some serious money in the Forex market using a strategy that Wall Street doesn't want you to know. It's called arbitrage. We're diving deep into the strategies, the risks, and everything in between. We'll be covering everything from different types of arbitrage to identifying those golden opportunities in the market. You with me? Then let's get started. First things first, let's break down the different ways you can play the arbitrage game in Forex. The two main types are two-point arbitrage and triangular arbitrage. Two-point arbitrage is all about taking advantage of price differences for the same currency pair but on different exchanges. You'd buy the undervalued pair on the first exchange and simultaneously sell it on the second exchange, locking in that tiny profit. Now, these opportunities are usually gone in a flash. We're talking milliseconds, which is why you need lightning-fast execution and preferably some algorithmic help. Now let's talk about triangular arbitrage. This strategy is a bit more involved, but the potential reward can be even greater. It involves three currency pairs and exploiting price discrepancies between them. Let's say you're looking at the EUR USD, USD JPY, and EUR JPY pairs. By calculating the cross-exchange rates, you might find that there's a discrepancy that you can capitalize on. For example, you could convert EUR to USD, then USD to JPY, and finally JPY back to EUR, ending up with slightly more euros than you started with. You have to factor in trading costs, slippage, and the speed of your trades. But hey, that's what the rest of this video is for, right? Now that you know the different types of arbitrage, the million-dollar question is, how do you actually find these opportunities? They scan multiple exchanges simultaneously, looking for those fleeting arbitrage opportunities. Think of it like having a team of super-fast robots working for you 24/7. These algorithms can detect price discrepancies in milliseconds, much faster than any human ever could. Start by focusing on highly liquid currency pairs like the EUR USD, USD JPY, and GBP USD. These pairs tend to have tighter spreads and more arbitrage opportunities. You also want to pay attention to news events and economic releases. These can create volatility in the market, leading to more price discrepancies. Remember, arbitrage is all about speed and efficiency. Set up price alerts, use real-time charting tools, and don't be afraid to experiment with different algorithms and software. The more you practice, the better you'll become at spotting those profitable trades. All right, you found an arbitrage opportunity. Now what now? Let's break down the actual execution process for both two-point and triangular arbitrage. For two-point, remember, you're buying and selling the same currency pair on different exchanges. You need to place your orders simultaneously to lock in that price difference. This is where your trading platform or software comes in handy. Many platforms have a feature called one-click trading, which allows you to execute both sides of the trade with a single click. Triangular arbitrage is a bit more complex because you're dealing with three currency pairs. You need to make sure your orders are executed in the correct sequence to avoid any currency exposure or unnecessary losses. This will automatically cancel any remaining open orders once your target profit is reached. Remember, practice makes perfect. Start by trading small amounts on a demo account to get a feel for the execution process before risking any real money. And always double-check your orders before hitting that submit button. Okay, we've talked about the exciting stuff, but now let's get real for a second and talk about the not-so-fun part, trading costs. See, even though arbitrage seems like free money, there are always costs involved, and those costs can eat into your profits if you're not careful. The biggest culprit, spreads. Remember how we talked about those tiny price differences between exchanges? Well, the spread is the difference between the bid and ask price of a currency pair. So even if you find an arbitrage opportunity, you need to make sure the potential profit is larger than the spread you'll be paying. Some brokers charge a flat fee per trade, while others charge a commission based on the volume of your trades. Then there's slippage, the silent profit killer. Slippage happens when your order gets filled at a different price than what you requested. It usually occurs during periods of high volatility or when you're trading large order sizes. To minimize slippage, stick to highly liquid pairs and avoid trading during major news releases, and always use limit orders instead of market orders. This will give you more control over the price you're willing to buy or sell at. The bottom line is don't let trading costs catch you off guard. Factor them into your calculations and make sure you're still profitable after accounting for all the fees. Remember, every penny counts. All right, we're almost at the finish line. You know the types of arbitrage, how to find opportunities, and how to execute trades like a pro. But here's the thing about trading. It's not just about making money, it's also about not losing it. That's why risk management is so crucial, especially in the fast-paced world of Forex arbitrage. See, even though arbitrage is considered a low-risk strategy, it's not without its risks. First up, market risk. They can disappear faster than you can say buy low, sell high. Then there's technical risk, which is the risk of something going wrong with your trading platform, your internet connection, or even your broker's systems. The risk that you won't be able to exit your trade at the desired price because there aren't enough buyers or sellers in the market. First, never risk more money than you can afford to lose. Arbitrage might seem like a sure thing, but trust me, it's not. Start small, diversify your trades, and gradually increase your position size as you gain experience and confidence. Second, use stop-loss orders. Remember, in the world of trading, risk management is just as important as profit generation. Be smart, be cautious, and always protect your downside. So, there you have it, your comprehensive guide to Forex arbitrage trading. We've covered everything from the basics to the more advanced concepts. Remember, arbitrage is not a get-rich-quick scheme, but with the right knowledge and approach, it can be a rewarding way to diversify your investment portfolio and potentially boost your returns. If you found this video helpful, hit that like button, share it with your friends who are interested in trading, and subscribe to my channel for more insightful videos on Forex, investing, and building wealth. Until next time, happy trading!